Welcome to The Explainer. So what if I told you that in today's frankly chaotic market environment, you don't actually have to choose between equity, debt, and commodities? Look, we're currently staring down a very specific, highly unusual macroeconomic setup in 2026. And today, we're going to break down the one mutual fund category that's literally designed to hold all of these assets at once. Yeah, we're talking about multi-asset allocation funds, or MAAFs. Let's just dive right in, because the timing for this discussion absolutely could not be more critical.
Okay, 4.74%. Let that sink in for a second. That is the elevated U.S. 10-year Treasury yield we're seeing right now in late August 2026. Now, in the financial world, high interest rates like this usually mean investors can get great yields just from holding safe debt, which, historically speaking, puts a ton of pressure on riskier assets.
But then, you look over at the commodities market. Despite those sky-high yields, gold is sitting at an absolutely astonishing $4,624 per ounce. I mean, it is completely defying gravity right now. Driven by geopolitical uncertainties, central banks buying up everything in sight, and massive safe haven demand, gold is just soaring at a time when all the traditional textbook models say it should be struggling against those 4.74% bond yields.
And guys, it doesn't even stop there. Jump over to the silver market and we're seeing explosive prices right around $69.47 an ounce. Silver has this crazy dual nature. It's got both investment and heavy industrial demand, which makes it incredibly volatile, but also highly lucrative right now. So, put it all together, we've got high interest rates, surging precious metals, and honestly, super uncertain and expensively valued equity markets. It's an incredibly high-stakes environment.
Which inevitably leads us to the million-dollar question. How do you actually invest in this market? Right? Like, how do you build a resilient portfolio when every traditional rule seems to be completely bending? Well, that's exactly where we introduce the all-weather vehicle. It's purpose-built to handle high rates, strong metals, and choppy equities all at the same time, the Multi-Asset Allocation Fund. So here's our quick rundown for today's explainer. We're going to cover the 2026 market environment, what multi-asset funds actually are, how they make you money, the top funds you need to watch right now, the hidden market risks you simply can't ignore, and finally, the final verdict. All right, kicking things off with sections 1 and 2, the 2026 market environment and what are multi-asset funds.
So fundamentally, a multi-asset allocation fund isn't just your standard run-of-the-mill stock portfolio. It's a hybrid mutual fund mandated by SEBI in India to invest across at least 3 different asset classes. In real-world terms, that means you're getting a strategic mix of equity, debt, and commodities. Essentially, you're buying multiple engines of return packed inside one single fund. It's a real game changer.
To put that into perspective, imagine you invest, say, 10 lakh rupees. The SEBI framework dictates that a strict minimum of 10% is locked into equity, 10% goes to debt, and 10% into commodities. But the real magic is that massive 70% slice left over. That chunk is completely flexible. It leaves the door wide open for the fund manager to dynamically allocate your money based on where they see the absolute best opportunities in this wild 2026 market.
Moving right along to section 3, how MAAFs make money.
Okay, so the absolute beauty of this setup is how the fund essentially acts as a ruthless, automated trader on your behalf. Think about the power of automatic internal rebalancing. Let's say gold has a massive rally, just like we're seeing right now. Well, step 1, the asset rises in value. Step 2, it becomes fundamentally expensive and suddenly takes up way too much weight in your portfolio. Step 3, the fund manager automatically trims that exposure, locking in those profits. And step 4, they redirect that cash right back into equities or debt that might have become relatively cheap. You are literally selling high and buying low constantly without having to lift a single finger. All right, let's get into the good stuff. Section 4, top funds to watch. First up, we have the aggressive category leader, the Quant Multi-Asset Allocation Fund. Just look at that 3-year CAGR. That's the compound annual growth rate, sitting at a staggering roughly 23%. They're pulling this off through a highly dynamic, very aggressive approach, heavily utilizing a meaningful allocation to commodities. If you're an investor who's comfortable with a fast-moving, punchy strategy, Quant is putting up some very serious numbers.
Next up is what I like to call the best all-rounder, the Nippon India Multi-Asset Allocation Fund. Here you're looking at a 17.7% one-year return, a 20.8% 3-year return, and a highly respectable 16.75% annualized over 5 years. Add in a massive scale of nearly 16,900 crore rupees in AUM,
assets under management, and you've got a seriously impressive combination of high performance, deep scale, and a really well-established track record.
And of course, we absolutely have to talk about the industry giants. ICICI Prudential is an absolute behemoth with nearly 86,785 crore in assets, reliably delivering solid mid-teens returns over the last 3 years. SBI is also sitting at a very healthy 20,000 crore with a 16.6% 3-year return. Now, sure, while these guys might not be the absolute top-tier returners like Quant, their massive scale and bulletproofed established processes offer a highly reliable, balanced approach.
Now, there are definitely other players in the space worth keeping on your radar, folks like WhiteOak, Aditya Birla, UTI, Tata, Kotak, and DSP. But I want to give you a very firm warning right here. Do not make the mistake of comparing a shiny, 1-year track record from a brand new fund against a 5- or 10-year track record from a seasoned veteran. In multi-asset investing, seeing how a manager navigates full, brutal market cycles is literally everything.
Now, at this point, you might be wondering, hey, why pay a fund manager at all? Why not just buy the Nifty 50, a debt fund, and a gold ETF myself? And hey, you absolutely can. But let's contrast that DIY approach against the MAAF approach. The MAAF gives you automatic internal allocation. When they rebalance, the whole shebang happens inside the mutual fund structure itself, which can be highly tax efficient compared to you personally taking the capital gains hit every time you sell one asset to buy another. Plus, it saves you from having to make constant emotionally driven decisions every single time gold spikes or the stock market takes a dip.
But we got to be realistic here. Section 5, the hidden market risks.
Let's rapid fire through the 4 main risks, because you need to know these. First, a gold's correction. Gold has had an absolute monster run, and a sharp pullback, it's entirely possible. Second, silver volatility. Sure, it can rise rapidly, but trust me, it can crash just as fast. Third, high yield pressure. Remember those 4.74% bond yields we talked about earlier? They heavily increase the opportunity cost of holding non-yielding metals. And finally, performance chasing. This is the ultimate retail trap. Just because a fund delivered 20+% recently does absolutely not mean it's going to do the same in the next market regime. Past performance does not guarantee future returns. Bringing it all home.
Section 6, the final verdict.
Before you even think about pulling the trigger on any of these funds, here is your exact due diligence checklist. You have to look way beyond the historical returns charts. Check their current asset allocation. Are they sitting way too heavy in gold right now? Check the expense ratio. Analyze the volatility and the maximum drawdown. Really try to understand the fund manager's process. And above all else, honestly determine how it actually fits into your existing portfolio.
And speaking of fitting in, how should it fit? Look, a MAAF acts as a consolidated sleeve within a long-term portfolio building block strategy. Please, whatever you do, don't dump your entire net worth into one single fund. For context, a balanced investor might aim for maybe 50 to 70% in core equity, 15 to 30% in fixed income, and 5 to 15% in precious metals. A MAAF can effectively cover a huge chunk of this entire strategy in one fell swoop, giving you the diversification, the discipline, and most importantly, the ability to stay invested through chaotic market cycles.
So as we wrap up this explainer, I want to leave you with one somewhat provocative thought. The goal of investing isn't to perfectly predict which asset will win next year. The actual goal is compounding your money smoothly through entirely different market regimes. Based on all the data we've decoded today, if you had to declare a long-term winner to anchor your portfolio right now, would you choose the aggressive approach of Quant, the all-arounder Nippon, or maybe the massive, reliable scale of ICICI Prudential or SBI for the next 10 years? Really chew on that question, apply it to your own strategy, and keep building that long-term wealth. Thanks so much for learning with me today.